Hello and welcome once again to the Smart Money Dumb Money Show. I'm your host, as usual, Keith Richards. I'm a technical analyst, as you know, and I'm president and chief portfolio manager at Value Trend Wealth Management. And we usually talk about equities on this show, but today I have a bit of a treat for you because we have a person who is in the opposite sphere of what I'm familiar with, which is the fixed income world. And I'm pleased to welcome Matt Montemurro, and I hope I've said your name right, Matt. I'm just going to read his bio, so you'll see me looking down. Matt's an MBA and a CFA, so he's they always say smartest guy in the room. That's this guy. He's actually the lead portfolio manager for the fixed income products at BMO. So, and if you know anything about BMO ETFs and funds, they've got a pretty wide range of these products. So Matt's been there, done that. He's got a fairly good background in the whole realm of fixed income, but he's pretty adept in high yield. And another subject I'm actually a little bit interested in, we'll pick his brain on, is emerging markets debt, that kind of thing. Because as a technical guy, I'm noticing possibility of the beginning of a breakout on the emerging markets bond ETFs that I've been following anyways. So we'll pick his brain and see if we can gain some smarts from Matt today on fixed income. So Matt, welcome to the show.
Thanks for having me, Keith. Looking forward to chatting today.
Yeah, well, so again, Matt, we had a quick chat before we started the show here, and I mentioned that a lot of my audience is very familiar with equities. Maybe not as familiar with fixed income. So why don't you give us the landscape for fixed income today and where you may see opportunities and why any investor should be looking at fixed income. So give us the big picture.
Yeah, absolutely, Keith. So, looking back a little bit, you look at 2022 and it was a disastrous year for all asset classes. And it was only the third time in 150 years that we saw calendar year negative returns for both bonds and equities. So, I think a lot of people struggled last year. Fixed income was supposed to provide stability in portfolios, and last year was a little bit of an anomaly, and it did not do that, and everything kind of went down on the investor side. I think it was a very unique market where we saw rates in Canada go from 25 basis points to 450. They continue to go up to 5% now as we sit here. I think as we turned into 2023 and as we look forward for the rest of this year, I do continue to see a lot of opportunity in fixed income. And people say, oh, well, why do you see that? Well, we had, such negative returns so that I think now we have an opportunity ahead to take advantage of what fixed income traditionally was, providing investors with both income and stability. And so, if you look back again to 2009, because we've seen this kind of historically low interest rate environment, a lot of investors have been forced to move out the credit curve, so taking longer duration risk, more interest rate sensitivity, and down the credit curve to adding EM, like you mentioned, high yield, just to make the basic income needs that a lot of investors require from that fixed income allocation. Well, the paradigm has shifted. We're looking at overnight rates at 5%, and that provides a lot of opportunity for investors. And it's a new world. It's a place we haven't been. We haven't seen rates this high in the short end since the early 2000s. So when I look forward, I see opportunity in that way. So when I look at the market as well from a high level, what we also have seen is the persistent inversion of the yield curve. So we're seeing shorter term rates higher than longer term rates. And this has persisted now. This is the longest inversion of the U.S. yield curve, I think, on record. And it's not going away anytime soon. So what that tells me is, how do we take advantage of that? How do we take advantage of these shorter term yields, right there around that 5.5%, and then also protect ourselves on the long end. So, when I look at opportunity and where I see fixed income going right now, I think short-term credit is something that is valued extremely well. I think if you look at asset manager flows, everybody is pouring into short-term fixed income. And I think it's that risk return trade-off that you see. It's 5%, 5.5% yield, and you're getting a half a year, maybe a year duration. That risk reward, that risk to volatility is extremely attractive in the market, and something that's unique that we haven't seen in a very long time. So I like the short end of the curve. I think there's tons of opportunity for the next year ahead in the short end, because I do believe that we're going to be in a higher rate environment for longer. I think inflation, although we've made some meaningful strides, we just saw June's print be under 3% for the first time since 2021. I still think that core inflation is going to be sticky, and that the Bank of Canada and the Fed are going to hold those rates higher for longer. They're not going to take any chances on lowering rates too soon. So for me, that means investors stick to the short end, clip that high coupon while you can, lock in those higher rates. I think that's an extremely attractive trade right now from an overall yield curve perspective. If you wanted me to go into a little bit more on credit, I see a lot of value in investment grade credit. I'm bullish on investment grade credit, but I'm not so bullish on high yield. So I like investment grade over high yield. So reason being on high yield, I think there's a lot of headwinds to come. So we saw record issuance after March 2020 of new high yield debt. That debt was issued at 3 to 5% coupons. 3 to 5% interest rates. They're going to have to refinance in the next about 6 to 18 months. They're going to have to refinance at 11, 12%. That's going to put a lot of stress on business models. That's going to put a lot of stress on high yield issuers. If you look at the high yield market as a whole, in general, on average, historically, the percentage of the high yield market that would be deemed distressed. So OAS spread, the option adjusted spread over 1,000 is how they define distressed. Generally around 5 to 7%. Right now we're sitting around 13%. So that tells me there's going to be some cleansing to be had. And the second part of that distress rate is that default rates haven't ticked up. They've started to go up a little bit higher, but we're still at just over 2% versus historical averages of about 3 to 3.5. So what I think is going to happen over the next 12 months is that we're going to start to see a little bit of cleansing. Some of those distressed companies, they're going to go under. But I think that's normal. I don't think it's a contagion event. I think it's normal for some of these lower end companies to default. Well, maybe we see default rates go to 5 to 6%. That's my view for the end of 2024. So right now, I look at it and say, high yield, lots of risk ahead. I'm concerned about it. Investors used to use high yield to enhance yield, or enhance the yield or get the income needs they required in a portfolio. They can get that from investment grade. They can get almost 6% yield in short-term investment grade credit. It's, for me, that's a winning trade. So I like the short end of the curve. I like credit, specifically investment grade, and I think both Canada and the U.S. are very well positioned from an overall, corporate perspective. So that's where I'd be looking at seeing the most value in the kind of the next 12 months in the fixed income market. Okay,
so good, yeah, and that's you took the question right out of my mouth, because I was going to ask you about the high yield stuff, and yeah, the spread is huge. So I wanted to touch base on, actually, just before I get to that, I have to put on my technical hat for a second, and just leading into your thoughts about short-term rates being so high. It's an inverted curve, which isn't always wonderful for equities down the line, but we'll see. Yeah. Whatever the case, that also competes with equities, of course. Why, when you can get a risk-free rate of 5, why would you try to get 7 on stocks or something? Mm-hmm. Unless you think AI is going to keep making 20% a year for the rest of your life. Then I've got some swampland in Florida to sell you. But anyways, technically the long bond, and I want your comments on this. So there's there've been a very long-term trend lines since going back to the before the early 2000s, where you could I literally was drawing for many years this long-term trend line, peak trough, very, very neat and tidy, broke down, as we know, past couple of years, fell like a brick. And now it seems to be basing, but it's way below that old trend line. But now the market's in this kind of, if you look at the TLT, like the 20-year or whatever, or the 30-year, it looks like this, right? It's going like sideways. Often when, as a technical guy, when this kind of stuff happens, when you see a base, you often, that usually means the end of the bad times. It doesn't necessarily mean good times coming, but it does mean, okay, the poop's hit the fan, we've seen the damage, and now it's trying to build some sort of a base. What is your perspective on the longer end of the curve? Now I'm talking US treasuries, but you could translate it to Canadian, I guess.
Same. Yeah.
What is your perspective on the potential for capital gain upside? In other words, a breakout by the bond prices going forward. Do you have any thoughts on that? I mean, inflation being what it is, and I agree with you 100%, by the way, on that. So.
Yeah, no, I think that there's opportunity in long duration. I think it's a timing thing, if anything. As you know, I think we've been talking about it with clients since last summer, and what we've seen is, I think there was a big add duration trade at the end of last year, at the beginning of this year, and I think that started to temper a little bit in terms of what we've seen recently, and part of that is, I think that higher rates for longer, there's optimism in the market that we're going to see rate cuts. And that's kind of the main area where you're going to see big value in that long treasury, long federal bond exposure is when, the Fed or Bank of Canada is forced to cut rates. That's where you're going to really see that upward appreciation from a price perspective. So I definitely see value in the long end. I think right now, while you're seeing that kind of base, like you were saying, I think the market is kind of putting in a cap on long-term rates by saying, okay, well, we don't think that basically the entire curve, we don't think that the long end is just going to swing up. So we think there's going to be some sort of yield curve normalization. So, we don't know necessarily when that's going to be, but I think right now I would say, I think adding long duration exposure to the portfolio, over the next 18 to 24 months, I think it will be a positive contributor to performance. I think it might be a little bit early. I think I would put it now as a defensive mechanism rather than necessarily a capital gain, but more so as a volatility offset that if we see higher rates and we see equity markets kind of pull back, that long duration exposure is what's it's going to be risk off. People are going to be buying treasuries, especially in the long end. And that's going to be that ballast in your portfolio. But what I would say is I think in the next 6 months, we'll start to get a little bit more of a clearer picture as to what the expectation of the Fed and Bank of Canada is in terms of cutting rates. And I think that's when that move, when we get a little bit more clarity, that's when we start to see maybe the breakout in the long end, because that's where you say, okay, I think the market's always been very optimistic about rate cuts. And now we keep hearing the narrative, expect higher rates for longer, expect higher rates for longer. So I think it's starting to creep its way in. So I do think there's opportunity in long duration. I might be worried today that it might be a little soon to put that trade on. But I do think that in the next 6 months, I think we could start to see the environment where, 2024, I think could be a very, very attractive market for long bonds.
Yeah, I mean, again, technical people, we wait for a base breakout. We don't buy in the base, but it's kind of setting up. So it's interesting. I was going to ask you, one of the things we agreed that we would talk about. My viewers know that I always talk to the guest beforehand to find out what we should be talking about, because you're the expert, not me in this area. But we were going to talk about buying direct bonds versus buying ETFs that hold bonds. And I think what can tie into that, if you don't mind tying it in, is the question I have about the emerging markets bond, because obviously, go out and buy some, Mexican bond or something, maybe isn't a great idea by itself, but in a platform like an ETF might make sense. So maybe you can comment on why and where one would buy an ETF for bonds, and also tie it into the emerging markets.
Yeah, sure. So yeah, we're seeing a proliferation of the usage of ETFs. There are hundreds of ETFs now, or actually thousands of ETFs now in Canada. So there's no shortage of things to choose from. And I think that's that's a challenge in finding the right ETF, but also it's the benefit of the ETF because it allows you to pick and choose the specific part of the market that you want to get exposure to. So traditionally, I think it's always been a challenge for investors to run a bond portfolio. If you're a do-it-yourself investor, if you're an advisor, you're working with either your discount brokerage or your retail bond desk. And basically it's based on the inventory that they have available on a given day. So, buying a Bell Canada 28 bond today, you come back a month and a half later to rebalance, that may not be available to buy or sell. So now you have to buy another bond. Now you have to buy a Rogers bond, or now you have to go into the energy space. So you're kind of you're not necessarily building the portfolio that you want. You're building the portfolio that may or may not be available based on the discount brokerage or the retail balance sheet at the time. So what ETFs have allowed investors to do is it's given more choice. It's given institutional tools to do-it-yourself investors and advisors to basically say, you know what, I want I want short-term Canadian corporate bond exposure. Well, I can buy an ETF that does that diversifies away any idiosyncratic risk. And I could do it in a quick and efficient way in a single trade. A month later, I want to add to that position or I want to take away that position. Again, single trade. I don't have to worry about dealing with the bond desk if there's inventory, where are the prices. So we are seeing a huge uptick in the use of ETFs for those specific reasons. And tying it into that EM, one of the biggest, and this is both institutionally and from an advisor or do-it-yourself investors, is the usage of ETFs for let's call it core asset classes. So let's say high yield, emerging markets, maybe it's TIPS, so inflation protected securities, where you may say, look, I know I think high yield or emerging market debt, it has great diversification benefits. It's got a premium yield because it's yielding 8% or 9% or 10%. But do I want to pick Mexico or do I want to pick Brazil or and by using the ETF, it gives you exposure to it in a single trade. So you can diversify away some of that individual either country or company exposure. But B, it also gives you access to these emerging market bonds that if you tried to go to, for us to be BMO Investor Line and tried to go up buy a Mexican local currency bond, maybe it's available, but if it's not, you're probably waiting on the bond trading desk line for 15, 20 minutes trying to get a price on the bonos. And, it's not going to be the most smooth experience. And at the end of the day, what are you actually getting? So I just want to show a screen here in terms of, I was talking a lot about the allocation. It's beneficial because it's transparent. It's easy to get in and out of different difficult asset classes. But there is actually a quantifiable execution benefit to using ETFs versus bonds. So if you look at this table here, the red column is an average retail bond spread based on this segment. So let's use this ZFS over here. So it's BMO short federal bonds. So these are 1 to 5 year short-term Canadian government bonds. Average retail spread generally if you went to your retail desk as an advisor or you went to your discount broker's bond desk would be about 75 basis points. So let's put that into context. If you are an investor or you're earning a 4% yield on your product, you are paying just over 20% of that yield just on execution alone. So you're basically just giving it away to the dealer. Where you could use the ETF, and because of the secondary liquidity, the differentiated buyers and sellers on the exchange, the ETF often and generally trades at about a 7 basis point spread, a 1 penny spread. So, when you use highly liquid and widely used ETFs, you can take advantage of some spread benefits from the ETF perspective. So in this case, for just 1 to 5 year federal bonds, you get 68 basis points back in your pocket, back in your return, just by using an ETF versus using a retail bond desk. And if you go down and you look at something like a long corporate bond at the bottom here, where spreads can be 2% versus 20 basis points on the ETF, that's 10x right there. So, you may be giving away half your yield just on execution. So that's why we're seeing more and more investors outside of diversification, outside of transparency, outside of, looking for ways to diversify away company-specific risk. We're seeing more and more investors use this because it's actually meaningful to their bottom line and to their returns. And the ETF has been it's really opened the eyes of a lot of investors as an efficient tool to get exposure. And basically, we get to pass through institutional pricing to the end investor using that ETF mechanism. So, from an ETF perspective or from an EM perspective, a lot of investors, institutions as well. So we have a ZEF, which is our BMO Emerging Market Bond ETF, very widely institutionally used. Because again, they may want the yield premium of EM bonds, but they don't want to necessarily pick Mexico versus Brazil versus China versus Philippines. They may just say, you know what, I just want the overall risk exposure. So that's what we're seeing, more and more investors looking at it from an institutional lens, looking at it from kind of a macro top-down perspective. And that's why I think a lot of investors are choosing ETFs for fixed income, and it's one of our fastest growing segments of the market.
So yeah, actually, Matt, before I was OSC portfolio manager, owning my own firm and all that stuff, I was retail investment advisor right from 1990. So I went through the whole boom of the bond market. It was fantastic. Rates were, just trying to remember, like you could buy good quality corporate bonds in the 8-9% range back then. Easily. And of course, rates plummeted and bonds went up like crazy. It was a great time to buy bonds. And I bought a lot of them, and you're talking about the spreads. Now I never saw 1% spreads, and we did see that's a pretty heavy scalp, but regularly 50 beeps easily, like regularly, like 50, 60 beeps. So, you're right. It's like versus the way an institution like an ETF can pick up these same bonds for like 0.05, it's the difference is massive. And of course, the retail client, I can say, because I was back then, an investment advisor, and I'd see the spread right in front of me, and of course the bond desk is just kind of trying to make some juice for themselves, but maybe protect themselves too. I don't know, but whatever the case. And then often the retail investment advisor would tack on a little bit for him or herself too, right? So, you could be in that 1% if you got paid full retail price, so to speak, on a bond, and you're right, it came out of their inventory. And if they didn't have ABC bond, then you just chose another one, right? And it wasn't necessarily the best bond to be buying, and you're not necessarily getting the best price because all the different desks had different prices too, So anyways, I didn't mean to interrupt, but just verifying everything you just said. I do want to continue probing you I know I'm changing subjects a little bit, but going back to the emerging markets, because I did see that breakout, and I'm just curious about, what are you guys looking at? Are you guys looking at a potential for emerging markets bonds being an okay place to be, especially with the US dollar being so low?
Yeah, so I would say emerging market bonds, it depends on the time frame as well. So I think emerging market bonds long term, they provide some excellent diversification benefits, very low correlation to your traditional Canadian fixed income. I think a correlation of it's like 0.2 or 0.3. So with a yield enhancement and good and strong correlation benefits, that can lead to better outcomes over the long term at a portfolio level. Looking at the breakout, I think I do have some concerns in EM. I think I think Canada and the US look to have started to control inflation. I don't think that is the case in many of the other countries, especially in the EM countries, where if you had an ETF, our ETF doesn't, but if you had exposure to Argentina, you're talking about 100% inflation. You're seeing overnight rates in places like Pakistan at 25%. Those type of rates to quell off inflation, think it's a dangerous period. I think some of the breakout that we've seen recently is that the IMF has actually come in and kind of backstop quite a few of these emerging market nations, making sure that they can pay their debt and make sure that as long as they restructure, nothing's going to default. So that's good, and that's been a catalyst in the EM market. But I do look forward, and I do have some concerns, especially in the near term, as countries like Pakistan, the Philippines. Ukraine is still a big portion of a lot of emerging market debt. So they're still in the midst of a war. Those type of countries, I think, do have some headwinds ahead of them, and I think it's going to take them a lot longer to control inflation. And I think with rates at 25%. The only thing that can happen is that growth is going to slow down there. So I think long term, I think there's opportunity. I think it's a good portfolio building block, but looking to add the position, I'd just be a little bit concerned because I think some of that catalyst was more on kind of the IMF coming in. Like they came in, I think we saw on kind of a 10 to 15% rally in Pakistan bonds just at the last week of June or first week of July, because the IMF came in and said, nope, we're not going to let them default. They're going to restructure. We're all good. So it's kind of like an external force that is causing a little bit of that breakout in that catalyst. So I am a little bit concerned about EM credit as a whole, but longer term, hey, I think you start to see, we did see a little bit of negative returns last year. If we do see some sell-offs, I think long-term EM has a place in a overall fixed income portfolio context.
Excellent. Yeah. So it's interesting because I posed the same question to Craig, who does the bond portfolio mostly at Value Trend, and he pretty much echoed the same thing. He said, look, there's too many moving risky parts in that part of the world right now. And he wasn't comfortable with the trade. So we never ended up buying. So that's interesting. Great minds think alike, right? So, okay. So was there anything, like I was going to ask you the final question, which was the market indicators and whatnot, but was there anything else you wanted to cover on your charts here?
So one of the, so actually, you know what, I forgot to bring it up before, but if you're still seeing my screen, just in terms of why I like credit, I mentioned in my overview at the beginning, I like investment grade credit. And one of the reasons why I like it is if you look at Canadian credit, you look at levels now relative to historically in the 10-year average, we're about 40 to 50 basis points wider than the 10-year historical average. And what that tells me and says, okay, we saw an equity market rally last year or to start this year, and we've seen a risk-on environment overall. Well, why aren't Canadian credit spreads, and U.S. credit spreads for that matter, tightening more? Why are we still sitting wider than those historical levels? And for me, the reason is I think the bond market is bearish, and they're thinking that a potential slowdown in growth or recession is coming. So they're not willing to pour into corporate bonds and tighten those spreads up to historical levels. So for me, that downside, some of that spread widening that you might see during a recession, during a slowdown, has already been priced in. We're already sitting at those wider levels. So for me, it's like, look, you're getting a 5% yield. You can lock that in now at spreads that are 30 to 40 to 50 basis points, depending on where you are on the curve, wider than the historical norms. That's going to weather some of the downside if we see a growth sell-off. And then I think when you flip things over, and if it's a softer inflation, it's a softer landing, what we're going to see is we have a lot of runway to see spread tightening. So I think based on where current spread levels are right now, not to mention current yield levels, I think investment grade credit in the short end is a wonderful trade right now.
When you're talking spreads, yeah, just so the audience knows, like it spreads off of the federal, in this case, I guess,
exactly,
Canada bonds, long bonds, I would assume.
So this chart here has all three. So the blue line is long bonds. So basically long corporate bonds.
Canadians, I mean. So long Canadian federal bonds, right? That's
exactly. So this is long, mid, short, and then overall corporate. So you can see that kind of it all has the same trend, but you're seeing kind of that same higher than that 10-year average across the board. But yeah, so it's basically the difference in yield from a corporate long bond versus minus the yield of a government of Canada long bond, and how that spread compares over time.
Yeah. I just wanted to clarify that so people knew what you were referring to. So, okay, sorry, I interrupted you. You were.
No, and then you had mentioned market indicators. And this is something, and I put up this like heat map of flows. And this is something that we're seeing an increased usage of ETFs, where it's not just, and someone who's on the technical side, I think this is something that we're seeing more and more regularly, where investors are actually using ETF information to put in their investment process. They're using it as data. It's free data. It's available. We have it available on our website. We post it monthly and we post it year to date. And what it actually shows is basically flows, AUM, money coming in or coming out of certain ETF products. And because the ETF market is so segmented, so for example, let's just look at the fixed income because that's my baby. You know, we have funds that go short along the yield curve, short, mid, long, and we have funds across the credit curve, corporate, provincial, federal. So what that allows us to do is see, okay, where are flows going? Where is money coming in? Where is money coming out? So in this case, we're seeing month over month, we're seeing a lot of money, the most amount of money come into long government exposure, so long federal exposure. Year over year, same thing, that trend. So what does that tell you? That tells you that the market, investors, and one of the things that I want to come back to is that, you know, this necessarily wasn't all that useful in 2010, in the early days of ETF adoption. But in 2023, we've seen a big increase in the user base of ETFs. So we have institutions, we have advisors, we have do-it-yourself investors, and they're all doing different things at different times. So what it really does is give you a good indicator of how the market is feeling, because it's a very differentiated user base. So in this case, it's telling you that, you know, month over month and year over year, so longer term trends are showing that investors are regularly putting money into long federal bonds. So we talked about that breakout of long bonds. Well, you're seeing it in terms of flows. And so what we're starting to see is a lot of investors say, actually, this is very valuable information. You see it in the US all the time. You see daily trading reports and say, oh, 3 billion went out of some of the US high yield ETFs. What does that mean? Does that mean there's a risk off trade? Oh, look, month over month, we saw 15 billion leave investment grade credit. You know, those are the type of things that, oh, that's a trend in the market. Because of the proliferation of the usage of ETFs and such a diversified user base, it can give us information as to how we can position our portfolios. So we're seeing a lot of investors use this information and layer it into their investment process. And again, it's not something that it's, oh, this is going to give you the answer, but often it is, hey, if you have a question and you're considering, is it time to put on duration? I think it might be time. Using something as simple as this, it's a free resource, looking and saying, okay, well, actually, you know what? The market's showing me that was a longer term trend and it's a shorter term trend. Investors in increasing amounts are putting money toward long duration product. And you can see the same thing on the equity side of the portfolio as well, where you're looking, okay, geography, is money going to Canada, US, global, emerging markets? Is it going into a specific factor? We're talking low vol, dividends, quality, all of these different heat maps, and we have a whole list of the breakdown, gives you information that you couldn't have got otherwise, especially in fixed income, which is OTC. It's very opaque. It's always tough to find trends. So, the ETFs have become an excellent indicator about trends in the market and really can help, solidify a specific view you may have, and or it may contrary. Maybe you say, it's time for me to go long duration, and then you're seeing, oh, wow, that's interesting. Why is there so many outflows in long duration? Did I miss this trade? Am I missing something? And we just hear a lot of that conversation go. And, I think, because of how segmented the ETF market is, high yield, investment grade, EM. You can really see those trades on a very regular basis. And we have institutions that I have calls with every week that I say, oh, here are the flows. We talk about the heat maps. Oh, that's interesting. Why is it doing that? So we're really seeing a widespread adoption of that. And again, the thing that I stress, especially to the institutional side, it's a free input that you can put into your investment process. We all have different screens that we look at, all the different charts, we look at all the different indicators. It's just another indicator that can just add a little bit of value. It's not a crystal ball, but at least it can help your decision-making process.
So actually tied into that, as I understand it, especially within the fixed income ETFs. Now I know equity ETFs are often driven, at least by a large part, by retail investors. They're the buyers. But with fixed income, at least from what I'm hearing from you, a lot of the ETFs are being bought by the institutions, like they're actually being used by the larger money. And we, in technical analysis, I do a lot of work on sentiment, and when we have we group people into two groups, smart money and dumb money, which is a kind of a cute little way of saying institutional versus retail. And when I see flow by retail, into something, then
Yep.
Sometimes I get worried, right? It's a contrarian indicator. But when I see flow by institutions, and that seems to me that's what your bond indicator here is telling me, that if we're starting to see the darkening on the government long bonds, that means that there's more money flowing into those ETFs, and a lot of that is institutional money. Is that correct?
That is correct, and that's where I think like you said, I think traditionally the ETFs were a retail product, and we've seen institutional uptick over time, but the fixed income space is something that over the last 6 or 7 years, we've seen kind of that spike in exponential growth in the usage of ETFs. And we've gone, we're probably close to 50-50 now in terms of institutional versus kind of retail users of fixed income ETFs. And you're completely right. It is a higher percentage than we see on the equity side. And I think part of it is, inherent challenges in the fixed income market. There's liquidity concerns. There's different parts that we don't, or different factors, opaque factors that challenge the fixed income markets. So a lot of asset managers and institutions are using the ETF as not only exposure vehicles, but trading tools. Buying the high yield ETF now and leaving that in there for a month while they find the specific bonds that they want to buy. And then they sell the ETF and buy the specific bond. So that's what I would use. That's a trading tool. They get the exposure, they get the beta, and then they wait for their opportunity to buy the specific name, and then they sell it out. So we're seeing more and more institutions do things like that. And then we see, asset allocators that are looking, and they use these ETFs as levers and to put risk on and take risk off. And I think that is really showing through in some of the heat maps that I showed. But I think the fact that it's that 50-50 institutional to retail has really changed the market, because we really get a very diverse user base when you're trading ETFs.
Excellent. Yeah, and even for those who use stockcharts.com, which a lot of the viewers will use, it's kind of a common technical analysis website. They have heat maps, and you can look at long bonds. And that'll be the same idea, because they use the ETFs actually on those heat maps. So that's great commentary. Well, Matt, that was great. So we've learned a little bit about the bond market, and stuff that refreshed my memory. I remember those spreads that you talked about at the beginning. It's kind of funny. I hadn't thought about that for a while, but that's great. And just for the record, at Value Trend, in our equity platform, our fixed income platform, we largely use the ETFs, with the exception of some short-term stuff. We'll flip a couple of GIC type of things, just 1 year pay for whatever 1 year GIC to get a yield. But for our bonds, we 100% agree with you on that. The ETFs are the way to go. So thank you for coming and partaking of your wisdom, and maybe we'll have you on again in another year or so. I really appreciate you being here.
Thanks for having me, Keith. No, this was a fun conversation, and always happy to chat with you. And yeah, I'd love to come by whenever you got a spot for me.
Excellent. Well, thanks, Matt.